Hi, it's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. It is Thursday, July 2nd, and I'm delighted to be joined here by Roy Kuo, long-term friend of mine, a legend in London investment circles, has been around as long as I have, and he is CIO at Galilei Investment Office, Galilei Investment Office. Welcome, Roy. Thanks for joining us here.
Yeah, thanks for having me, Ethan.
Well, look forward to digging in, and let's have no further ado and pull up the slides. I've called this week's presentation Tight Lips Stop Ships. The tight lips referred to the tight lips of the Fed chairman, who's recently been speaking at Sintra here in Portugal in Europe. But some of his policy outlook, I think, a lot less transparent than we would have been used to. And the stop ships refers to the stop and go aspect of the opening of the Strait of Hormuz, which has been certainly the geopolitical pointer that has been more of a signal than others in markets recently. As usual, we will cycle through the 5 topics of inflation, interest rates, equity markets, geopolitics, and we'll touch on other asset classes. We are going to also revisit our discussion last week about Alan Greenspan and some of his legacy and just reignite some of the conversation around what it is that we have been left with after some decades of his time at the helm of the US Federal Reserve. In terms of some of the subtopics this week, again, look at inflation in terms of expectations versus reality. We are now, just this week, have been celebrating 250 years of the United States. And we'll look at the US exceptionalism in play there when it comes to the comparison of equity markets and equity market sentiment. Tied to that, we are still seeing a bit of the best of times and the worst of times in equity markets. There's been lots of other news this week, some pointers in terms of economic health and the vibrancy of markets, as well as the outlook for AI. And as I mentioned, some reflections from Alan Greenspan's era. Here is Roy's overview, CIO Galilei Investment Office with detailed experience across other asset classes. So Roy, let's dig straight in. So inflation, and we've been speaking about inflation all year. We have had kind of vacillation between optimism and pessimism regarding where it's heading, around deflationary forces versus just this strong underpinning, now being accentuated by components when it comes to chips. The need, for example, we've seen Apple with raising its prices by 20%. We have seen the pressure from the oil price receding a little. But what's your kind of base case now when it comes to inflation? Maybe we can touch on the US as well as the European scenario.
One thing that we've seen is that, well, services inflation has actually kept up and been fairly steady, but still at a fairly high level, so above the Fed's target. But the goods inflation for the previous few years has been kind of depressed, right? There's effectively been kind of like a goods industrial type of recession that's been going on in large parts of that part of the economy. But now you see PMIs in those areas have actually picked up. And then when we kind of look through to kind of what corporations in those areas are actually saying, they're thinking their orders are pretty robust. So they actually have a pretty bright outlook of how things are looking right. And one of the things that's translated into is that they're kind of basically saying that, hey, our margins are actually improving. For me, that means basically not only do you have kind of still relatively high services inflation, but that goods inflation, which has actually been one of the big contributors to inflation falling since the 2022 period, is actually it had actually helped stabilize and bring inflation down. But now actually goods inflation is actually maybe a contributor to inflation. And so that actually may start to push that inflation number up. And so your chart here actually kind of shows that, right? I mean, obviously, the portion of that is kind of AI-related CapEx spending, but we're actually seeing that kind of across the board in a number of industrial and goods manufacturing sectors. And so I'm a bit pessimistic about where inflation is going. I mean, I don't think it's going to go back to 5-6%. But I still think it's going to be very stubborn and staying in the 3-4% range, and that's probably obviously not very good when it comes to Fed policy, right?
Well, a great segue, and I think obviously it's early days for the new governor to be taking a new chairman to be taking a victory lap. And I think that there is a concern that there will be not only lack of communication regarding his next move, but equally higher rates and certainly higher mortgage rates, given some of the uncertainty regarding that, the volatility coming from some of this uncertainty. How do you see this as being a factor on economic growth and activity in general? How much is the economy dependent on lower rates continuing?
Well, the economy is actually dependent on lower rates at all, right? So I mean, what the economy is dependent on is that the government's spending like a fish, right? So, well, I refer to it as spending like a teenage girl with unlimited credit card limit, right? So, and it's effectively kind of like that, right? I mean, you're running 6-7% budget deficits. You're going to have a strong economy, right? Unfortunately, what that also means is that you're spending more than you're producing, right? And that obviously just leads to one thing. It leads to inflation, right? So interest rates have to stay high just to keep that in check, right? Which is obviously the opposite of what the presidency and the U.S. want. They just basically want unlimited growth, but they don't realize that unlimited growth just doesn't work when there's a kind of a supply constraint that's there. All it's going to do is contribute to higher inflation. And if you don't check that inflation, it's going to start running away from you, right? It's like Warsh is in a really tough situation. It's because, well, obviously he was appointed to do one thing, right? And you can't get away from that political aspect of that the presidency expects him to cut interest rates. But that's not what the data is suggesting what he should do, right? And you see that the market has priced in rate hikes rather than rate cuts, and I think that's right, right? That's definitely much more so in the U.S. than it is in Europe, and it's actually kind of surprising that Europe we're the first to actually hike rates rather than the U.S., even though the hiking rates is probably much more necessary in the U.S. than it is in Europe. So I think they're in kind of a stuck situation, right? And that's probably contributed to why they're so tight-lipped. They know that the minute they open their mouth and say what will probably have to be something that's fairly hawkish in terms of what they say, that's not going to happen. That's not going to result in a very happy reaction from the president.
Well, that's a great point. I mean, just to really play on the pun I used at the beginning, I mean, loose lips sinking ships, and certainly loosing lips would sink the ship of the US economy. The headline I have here, I was obviously prophetic. We had not yet had the jobs number when the jobs divergence headline was written, but actually subsequently to just in the last few hours, we have seen the jobs number come in at slightly lower than expectations. I think really we are in the kind of rounding error zone when it comes to jobs numbers. I don't think too much will be read into that. I think there's going to be a lot more focus on some of the other themes that are coming out of markets, particularly tech and concentration. I think 58,000 here or there on the jobs on a number that could be revised anyway backwards is probably going to be less moving. I'd like to just move to markets today now, and not necessarily just today, but just in terms of some of the trends we're seeing. And we have had this best of times and worst of times in terms of we've just finished the quarter, 2nd of July. So we're looking back at the second quarter. We're having the record. We had a 20% gain for the NASDAQ, one of the strongest quarters recent memory. Similarly, strong performance for the S&P. Discussing whether there's been a rotation. We've seen a strong performance from some of the defensive sectors, such as healthcare. And on the other hand, some individual stocks having the biggest, in the case of Microsoft, a pretty woeful quarter, and certainly last month, its worst monthly loss. And in terms of other performance, we've got this concept of the lag 7, with the semiconductors off to the races, bucking the trend in the Magnificent 7 sell-off. And just to mention one other part of this divergence, we're also seeing some pretty significant sell-off. I have it here in terms of gold. So it having a very bad quarter since the beginning of the year, of a very bad year, but a very bad quarter in particular. I think the worst going back decades. So what do you make of, let's start with equity markets. The current divergence that we're seeing, the Mag 7 falling out of favor, and then the picks and shovels still remaining in favor, so the semiconductors, but some question marks around all of them, perhaps.
Yeah, well, I think the whole chip sector is actually quite interesting, right? Because well, particularly like in areas that are a little bit more commoditized, like the memory sector, those areas that can actually have very strong pricing power when supply is very tight, right? And that's actually what you see. And then you see some just really astonishing kind of earnings prints, right? So I think Micron Technology by itself accounted for a huge proportion of the S&P's overall earnings growth, right? Just one stock out of 500. I think that effect is actually just kind of what you saw coming through, particularly in Q1, right? So it's, I mean, all through Q1 into also April and May. I mean, you actually had a decline in the PE ratio in the U.S. even though stock markets continued to go up, and that just because earnings were literally that strong, right? It's something that I just really never seen in my life in kind of in this sort of a mid-cycle type of situation. And obviously, it's all related to this huge capex spend that's occurring, right? I think what you're seeing more recently in June and also this month, particularly the sell-off in this month, is something to do with the fact that, well, there's just literally a limited amount of money that's going around that is available to people investing in one place or another. And some people have to sell out one sector in order to pile into another one, right? Or else stocks in one area just can't continue to keep going. In this case, you have this big divergence between the people that are spending on the capex, so the likes of your hyperscalers versus your semiconductors, because that's where the constraint is. And you had effectively a huge profit shift from one group to another group, right? And our market's going to bear that? Well, I'm not so sure, right? And I think actually what's actually going to be very interesting is this new series of Q2 earnings calls, when the likes of like a Google, Amazon, Microsoft, when they start talking about their capex plans, are they going to actually still continue at the rate of what they had previously indicated, or even accelerate that, given that the market response to previous announcements was very, very unfavorable, right? I mean, it's still a nuclear arms race, but you're getting to the point where the more spending that they're doing, they're just basically pushing on a string, right? All they're doing is just accelerating inflation and the things that are required for this capex, without actually delivering as much of the capex as what they're wanting to do, and actually getting into some sort of finished product where they can actually deliver it to service clients, right? And our clients can be willing to pay up that higher price. Not so sure, right? I mean, if you look at the cost of compute in the US from some of the hyperscalers, it's 10 times that of what's available in China in some instances, right? At some point, people are going to realize that, hey, we're going to just start shifting our compute to where that cost is cheaper. And you're already seeing that with some companies, right?
Well, I think you used a very interesting word, which is race. And certainly we've used that concept of the arms race a few times in the recent cycle. But what does strike me right now is that the race is being dialed up in terms of its intensity, its frenzy nature. And it's maybe because of the idea that China is stealing a march on many of these advances, that there doesn't take much time to close the gap. There has been, Microsoft has come out with its proactive messaging around the need to build that layer, the ontology layer over the underlying models, and that's critical to not lose control of IP at the company level. That was a very influential ex post written by Satya Nadella. I don't know that it has actually done much for the stock price. And I'm going to bring up a few other headlines, and then I'd like to just get back to this fact that we are being rushed along because things are moving very quickly on a global level. On the one hand, we have the yen at a 40-year low. So there's clearly going to be some action there in terms of the movement around whether they have to intervene. That's creating I would suggest that there's going to be stimulating quite a bit of trading around Asian markets. We have the oil price, which is subsided, but has been seeing quite significant movement there. We've spoken about the severe volatility in the Korean stock market, most of which has been driven by its $2 trillion companies there, Samsung, SK Hynix, and just the overweight that these two stocks represent, 60% of the market. So clearly a real microcosm of what could happen if things get volatile. We have not only a frenzied pace of development around compute and the microscalers, equally, investment products seem to be developed at a frenzied pace. Hot new derivatives. When I see that in the headline, I immediately get flashbacks from '08. These hot new derivatives are referring to some of the perpetual derivatives that do not expire, that are now becoming more popular. And I would suggest that that's also building quite a bit of frenzy into markets. And we also have the idea that the wealth is both growing and we're getting a lot more activity going on in venture. So I suppose my sense is that when anything moves with this kind of pace, this kind of we can't pause to take a breath to consolidate, this is when excesses and to get back to our favorite Alan Greenspan's discussion, when bubbles and exuberance start to build. And are you feeling this? You've been watching markets for decades. This sense of exuberance that is just getting to a frenzied point.
Yeah, I'd say definitely so. But I really think that's actually only something that I've only started to observe this year rather than previous years.
Yeah.
And I kind of equate that to, when Alan Greenspan, when he made that irrational exuberance speech, that was 1997, right? And obviously, it's like if you had gotten out of the stock market in 1997, you had missed a huge rally the subsequent couple of years. So I wouldn't put too much stock into it, but I think it's something that we're kind of conscious of. That bubble mentality starting to come to the fore, right? I think just anecdotally, I mean, I've seen that from my client base, and obviously my client base is ultra high net worth individuals, people that have the ability to invest in these things, and they're also fairly attuned, kind of fairly sophisticated investors. They can tap into private markets, public markets. And then all of a sudden, their ability and willingness to take risk has gone up quite meaningfully, which means one is that they've had some pretty good liquidity events. So there's a lot of cash effectively sloshing around. So they have the ability to actually put money into new investments. But yeah, they're also kind of chasing things, right? So they're asking me, it's like, well, can we and should we get into the likes of like Anthropic and OpenAI ahead of their IPOs, that sort of thing. It just got me thinking: are we just chasing something just for the sake of it without understanding what are the fundamentals of those companies, right?
I think this is a good time to talk about another development that's just in the last 24 hours since these slides were prepared. Alex Karp, CEO at Palantir, was on the NCNBC discussing, it was quite a kind of now become kind of a legendary segment just in terms of his saying the quiet part out loud, or maybe other parts that were not even quiet out loud, in terms of just I suppose, the jostling for positioning. His suggestion, just in summary, he divided the layers very much of this into the compute layer, the model layer, as well as this ontology layer, which is really the layer of the proprietary company intelligence layer that might be layered on top of any model, and how that really is the company's whole raison d'etre. And if that part is simply outsourced or used or hijacked or in some way now owned by the models, that would be a very unsatisfactory state of affairs, suggesting that perhaps the token economy was perhaps not viable long term, and that there would be some competition in that model layer. And I think very many other things suggesting that all was not well necessarily in these multiple embroiled relationships between, say, the Microsofts and the providers of the models, the OpenAI and the Anthropic. I think it's also notable that there have been some murmurs this week about delays of at least the OpenAI IPO into the next year, and equally we've had some volatility in the SpaceX IPO that did go out. So again, and the concept of the race. Was there a race to get these out at the time when sentiment was, as you mentioned, your clients, tip top in terms of demand for risk? And has he said something that is likely to send a chill through markets, because it's suggesting that these models cannot continue with this current business model?
Well, I don't think the market takes too much stock of what Alex Karp is saying. I think it's just something more about supply and demand, right? I mean, when you have an IPO that's over $1 trillion, you just have a lot of sellers, right? An IPO of that size with that many sellers, you just need a lot of natural buyers, right? And for the market to absorb something of that size, just generally isn't that easy, right? So we'll have to see, right? So I mean, if you actually have $3 trillion companies that are going to IPO this year, that's going to take a lot for the market to absorb. And I think that's one of the things why probably the likes of your hyperscalers were getting punished, because people were having to sell down those stocks in order to rotate into these newer names that they thought were going to be included as part of the index, right? I mean, thankfully it wasn't. Now it's shown to be that they aren't going to be included in the index anywhere near the size that people had feared that they would be. So that pressure has kind of alleviated a little bit, but still not entirely gone, right? And then in reverse, then that way, I think a lot of people that were in the SpaceX IPO, they were hoping that they were front running some of these index funds that were needed to buy into those shares, and then subsequently they didn't have to buy as much as what people had thought that they would, and obviously then you've seen that the selling pressure in SpaceX is actually much higher than what some people had originally thought it would be, right? And frankly, I think that the SpaceX IPO actually will probably actually have experience a lot of sellers, just because when you hear about all the people that were invested into its pre-IPO, a lot of people they're looking just to exit relatively quickly, right? So there is going to be some selling pressure for the next 6 months. Is that necessarily a bad thing? Well, I'm not so sure, right? If you remember back to Facebook or Meta now, when it first IPO'd, its stock actually sold off pretty aggressively as well in its first 6 months. And obviously, since then, in the subsequent years, obviously it's been one of the big winners in anybody's portfolio, right? So it's not necessarily it's the end of the world, but but you do have to kind of factor in these as an investor. You have to factor in these technical pressures, right?
Right. No, it's a great point. Well, I think this is a good time to move to the some of the topic. One quick question around geopolitics, because I think I've got a headline here, which is geopolitics rupture, transition, or irrelevant. And I think, we were still coming off the back of Davos and the idea that geopolitics was in a state of rupture. We've had various suggestions that that this is important to markets, but then maybe we're transitioning now as it's receding into the background to becoming less relevant. How do you see it? You work with a global client base. Do you see geopolitics as being relevant to clients and their asset allocation? Do you see it as being kind of a sideshow? How does it factor into your discussions?
Well, I think geopolitics is only one aspect when you kind of look at, say, the conflict between the U.S. and China, right? I think if you look at kind of developed markets, so kind of more Western Europe, and Japan, and the U.S. primarily, if you look at those markets, the big issue there is really that you've had this kind of social democratic market-based economy. And that's basically had its roots under the Bretton Woods system since World War II, right? And I'm not too sure that works anymore. At least it doesn't work that well for a large proportion of the population, as has been shown, right? I mean, effectively half the population is getting left behind, and then, as to your point with the K-shaped economy, the other half is actually doing well, or maybe like 20% of the population is doing extremely well. And it's like when you have the majority of your populace that's not actually benefiting from that system anymore. Yeah, politics are going to look ugly, right? I mean, when you look at who your voting population is, it's actually quite interesting. A lot of people that are supportive of your kind of right wing, kind of ultra right type of parties are actually also the ones that support the ultra left, right? Which basically means that they're just supporting anything that isn't the center consensus, right? So I think that's something that people need to understand. It's almost like we need to reimagine how does a market-based economy, how does it work, or how does it work in a way that's actually going to be beneficial for people, like what it was back in the 50s, 60s, that sort of thing, right? And I don't think we've come to that sort of solution. So you mentioned Davos. I mean, Davos was kind of your kind of post Cold War kind of economic Washington-based economic consensus. I think that's just been completely thrown out the door, right? Yeah. I mean, Davos is basically completely irrelevant at this stage.
Apart from the odd wonderfully delivered rhetoric in a soundbite. And I think this takes us nicely to just our concluding segment. I did want to revisit again. Last week, I had noted the passing of Alan Greenspan and some of his legacy. And I really raised some of the kind of the thought artifacts, I suppose, that he left us with, as well as the actual legacies of perhaps moral hazard. And the Greenspan put, we mentioned before that this was really post 98, this belief that the Fed will always be there to bail out the stock market, that was there, that was deemed to be, be yet maybe have saved some volatility in the near term. But I think you consider it a form of moral hazard. I'd love to hear your thoughts on that.
Yeah, my opinion on Alan Greenspan has changed quite a bit over time, right? So back in the 90s, I mean, you kind of think about it, it's like during 1987, he helped inject liquidity to kind of save the market from Black Monday. During the early 90s, he was very stringent on interest rates that kind of forced the government to become much more fiscally disciplined. And that kind of set the stage for kind of this kind of innovation, productivity-driven kind of economic growth that you experienced in the 90s, right? And then by the end of the 90s, you actually got to a strong fiscal balance. So that actually proved to work very well. And I think that all completely changed, right? Then he went on down on this. I mean, Alan Greenspan's a big fan of Ayn Rand. I think he just basically kind of decided that, well, he's God and he's going to implement what Ayn Rand told him to do. And that's basically say markets are best left to their own devices. And that proved to be completely incorrect, right? You can't leave market to their own devices because greed, some personal greed, doesn't work necessarily for the common good all the time. To put it a better way. And that's kind of the cause of the global financial crisis, right? So I think, the global financial crisis, a lot of that, the blame goes to Alan Greenspan because, yeah, he was the regulator and he didn't do his job as the regulator because he didn't feel like he needed to do his job as the regulator, right? I also find this fascinating that he basically decided that, like, oh, markets are perfectly happy to manage by themselves. But then he used his power as the Federal Reserve Chairman to go in and intervene in markets quite often, basically to save the markets from themselves, to the point now that basically people believe in the Fed put, right? Every time the market sells off, the Fed is going to step in. And then that's effectively kind of almost like a market consensus view nowadays, right? And I think that goes back to his days. I mean, people attributed more to Bernanke, but I think it really went back to the Greenspan days. And now it's just a kind of muscle memory for the markets, right? And then this is why people are pricing volatility fairly low, right? Because they don't believe that volatility is going to rear its ugly head to the extent that it's going to carry people out, right? They always think that the Fed is going to bail them out. And unfortunately, all that does is it just pulls that string until it snaps, right? And I don't think that's happened yet, but it could and probably will, right?
Well, an intriguing place we find ourselves. I think that is a lovely concept phrase, the market muscle memory, because yes, muscle memory can be of the pain as well as the pleasure. And I think the pain certainly of the froth of whether it's '08, I think we're seeing a little bit of muscle memory kicking in there in terms of excesses. But equally, we have a new Fed chair now who's not making his intentions very clear at all. So I think we're not so sure as to how this will work out, this intervention. Thank you so much, Roy. You've always given us so much food for thought. It seems like it's too short to bring us to an end here, but I'll conclude at the time frame I usually do. Thank you for sharing your insights here. And thank you, everyone, for watching the Markets Happy Hour podcast.
Great. Thanks, Ethan.